Joining us now to discuss is Monsur Hussain. He's the Senior Director at Fitch Ratings. Welcome to the show, Monsur. Good afternoon. So, reflecting on the recent ratings agency downgrades of Signature Bank, a popular crypto bank used by FTX, what is your outlook on crypto institutional firms?
Thanks for having me. It's a pleasure to be here. I think it's an interesting question that I'm not fully qualified to answer because I'm not working on the ratings side. One thing I would say that business model risks are a key issue for firms operating in the sector, given their concentration of clients looking specifically at crypto asset operations. And I think that business model vulnerability where particular firms or banks like Silvergate have concentration to specific clients could be of an issue generally, given the drop in transaction volumes you've seen in the ecosystem, and also more generally institutional fears regarding possible contagion.
All right, so we also, pardon the fire alarm going off in our building, unfortunately, but we also took a look at the Fitch blog and we saw that there is a look at the lack of crypto regulations and how that limits further U.S. bank participation. Do you think, perhaps you can go a bit into that and how, the current lack of clarity is preventing movement in the industry?
Sure. So ultimately, it's probably fair to say that the US is behind its major developed market jurisdiction peers in regards to enacting firm legislation and guidelines regarding crypto intermediation. And we think that's actually hindering US firms just because, firstly, without the firm legal and regulatory footing, there's a number of potential risks that the firms face, not least having safe harbor rules and guidance on how to operate effectively. And we think that where particularly the largest US firms are concerned, where they have global operations, the lack of coordination with regards to the US with other leading jurisdictions such as the European Union might not play in its favor, just because ultimately peers, for instance, in Europe, that do want to start intermediating on behalf of clients, they will have potentially the upper hand. That said, we think that globally, the fact that the US is a little bit behind the curve doesn't really help anyone, just because ultimately what adds to costs and complexities for all types of firms, wherever they're based, is just having an uneven regulatory playing field. And so we think that ultimately there's going to be a little bit more focus on the US to try to bridge that gap in 2023. In particular, there's a number of promising bills that have been presented. Yeah. In US legislative houses that will hopefully get a little bit more traction. And also we know that the US president has made a focus on digital assets one of the elements within the financial system that they're focusing on. So we think there'll be a lot more traction, particularly after what's been happening in the last 2 months.
That being said, SEC Chair Gary Gensler has spoken out and said, the SEC already has the authorities to at least provide basic disclosure and governance requirements in place and hold digital asset firms accountable. He spit that, in fact, today on Yahoo Finance, but failed to, of course, talk about crypto exchange FTX specifically. Do you think the SEC has that the guidelines for regulations in crypto firms and cryptocurrencies are already there, and the SEC has the power to enforce them if they so wish?
I mean, that's a really interesting question. It comes down to sometimes the characterization of the crypto assets themselves and indeed the services offered by crypto asset firms. So some crypto assets might well be securities, in which case they'll potentially fall under the purview of the SEC. Others might not necessarily be regarded as securities, and so if they are regarded as commodities, well, they fall outside of the jurisdiction of the SEC. And we saw that notably with regards to all these discussions concerning previous crypto assets such as XRP, and also with regards to the characterization of some of the operations of the crypto asset firms. So, for instance, BlockFi's interest accounts The BIAs in the US were classified as being related to securities and therefore were under the purview of the SEC, which then led to that settlement earlier this year in spring. But there are other services where they might not necessarily be regarded as tied up with securities legislation, in which case they won't be. So, I mean, some of these fundamental questions about characterization still remain.
All right. Moving on, Goldman Sachs, they're looking to spend tens of millions of dollars on crypto firms based on more sensible valuations, according to Reuters. Are there opportunities out there?
Well, there's certain aspects of the technology that's underpinning some of these cryptocurrencies and the DeFi protocols that are indeed remain of significant interest to financial institutions. And I think what you quoted about Goldman doesn't strike me as being particularly odd at all. We think that there's a great deal of value in the general concept of asset tokenization and also the use of private permissioned blockchains in order to build out particular ecosystems that can be used to transact with wholesale counterparties and potentially high net worth individuals also. We think there's also elements of the DeFi protocols that could be of interest for firms looking to advance a more leaner version of fintech and to potentially look at operating on a 24 hours, 7 days a week, 365-day basis without necessarily requiring human intervention. So I think there's lots of interesting applications of technology and interesting use cases, which haven't yet necessarily been built up to scale. But I think that's where it's luring financial institutions to take another look.